let's go ahead and get restarted. So this is the last session before cocktails. I'm Woodruff, and I'm gonna say a couple of things. First, I'm going to say how clever Emanuele is. He's got me up here twice. This time, I'm going to talk about his slides, his research, but he gets to sit and kind of just watch. So maybe he won't be happy about that. But this is a slide. This is a slide from a paper that actually Emanuele, Marcio, and Tommaso are all, and a couple other people are involved in, which is I said at 2026 that may be optimistic, but it's a paper that eventually will see the light of day. This is I'm going to show you two slides from this, just as kind of a way of framing this session on venture capital, private equity, and large firms. And then I'll introduce the panelists, and we'll have their intervention. So this is a picture that I find. This is just a picture that says this is really different from the small firm kind of mid SME kind of firms that we talked about this morning, in the sense that so across the bottom, across the horizontal axis these are country level data, country level average education, country level average education. And then up the vertical axis is the average education of startup founders. So startup founders that are in the sort of VC sort of universe, in a sense. And of course, the striking thing you see from this is that it's a flat, basically a flat cloud, a flat line across. So regardless of the education level of the country, the startup founders all have very high levels of education, and all kind of regardless of the country's education, they have the same level. And so that's the thing, just to say these are really different types of firms than the SMEs and the smaller scale firms that we often talk about. And if I think about Emily's map of where we've done research, and it being mostly on these sort of micro firms, that's most of the firms that are out there. That's why we do this. This is a place where we have not nearly enough research. So we're going to hear some things today, but we really have not enough research. At dinner last night, we were talking about more work that Emanuele and Tommaso are doing, and I said it would be nice to see research from somebody who's not Emanuele and Tommaso on this topic, because not that they don't do good research, but we need more in this area. I think it's quite important, and we have very little. So that's thing one. Partly we have little because it's a harder place to do research. There are fewer firms. The second thing I'm going to slide that I'll show you is also from this paper that's maybe forthcoming next year, or sometime in the decade, I hope. And this is from surveys of these are all clients of IFC, right? These are not all, but these are startups, basically. These are interviews with startups, and it's sort of survey experiments in as I may butcher some of this, but it's not. But the main point they'll get across. The main point is really to look at the top lines of what firms want, and what they want is equity, not debt. And then you go down 3 lines and you get what they don't want. What they don't want is anybody else to have a board seat. So this is a bit like, the sort of, I really want local currency, but okay, then the interest rate is 25%. No, I want the US interest rate and local currency. I mean, so there's sort of an inconsistency here, in a sense. They want equity, they want the risk sharing, but they don't want to give up control. So I think one of the questions that I want to put to the panel is going to be this: how do we think about equity versus debt? And I'm raising this partly because this is a live question for us at VII, and I think it's a live question for IFC and so forth. How much should we be thinking about equity? How much should we think about debt? Debt recycles faster. We can get more money to more people more quickly, but maybe equity has a role, and so that's one of the questions. Okay, so I'm going to start with we have three panels, great, fantastic panel, a fantastic diversity of views and opinions. I'm going to start with Paul Gompers from. I'll introduce all the panelists, and I'll go back to Paul. But I'm going to start with Paul. Needs no introduction, but professor at Harvard Business School, has done a huge amount of work, certainly one of the premier people in venture capital in the US. He's also been recently doing more work in emerging markets, and he's going to talk mostly about that. Then we'll go to Eghosa Omoigui. We practiced, I still didn't get it right, but he is a venture capitalist and I've got to get the company now. EchoVC. And so butchering everything. So look, it's almost midnight. So that's my excuse.
Chris started drinks early, guys.
And he'll talk about actually starting a venture fund and working in a venture fund in the climate and the work he's done in climate finance or climate tech in particular. And then Denis Medvedev is the chief economist for large industries at the IFC. Can give us sort of the perspective from the IFC. So let me stop there, and Paul, turn it over.
Great. This is a little bit like homecoming. 1994, I taught in this classroom, so it brings back memories. Anyway, I do want to focus more on sort of the work that I've been doing recently in sort of emerging markets. I've got a bunch of new projects with Emanuele, and I'm going to try to rope them into hopefully some more because I need a smart young colleague working with me. Anyway, maybe I want to start by actually motivating why thinking about high potential entrepreneurship and development is important. I'm an HBS professor. They genetically altered. All I think about is case studies. So one of the early case studies I actually wrote when I went to HBS was on the Yozma program in Israel. I'll come back to this in a second. One of the things that most of you may or may not know is in 1990, where did Israel rank in terms of GDP per capita? Guess. In the world. 56th. In 2023, where did they rank? 13th. And so much of that was actually driven by high potential entrepreneurship. The growth of the sort of startup, tech, venture capital ecosystem really transformed the economy there. And the Yozma program was a government program that really catapulted. And I'll come back to some of the elements which I think are really important. So one of the things that I've been doing over the last, say, 5 years has been work on emerging entrepreneurial ecosystems globally. In 22-23, I took an 18-month sabbatical. I traveled to 30 countries, 5 different month-long trips. My wife was very happy. Over the course of those 5 trips, had something like 500 plus meetings with founders, venture capitalists, government officials, DFIs, all the like. And it was really interesting to think about how they approach the development of a financial sector for high growth firms. And what was interesting is there's really sort of 3 archetypes, the first of which was the government-based approach. And everybody there basically said they were using the Yozma system to develop their ecosystems. We can talk about in a second. The second is very prevalent in sub-Saharan Africa. DFIs are a huge role. Donor organizations are a huge role there. And then the third is corporate venture. And so there are a lot of markets in which corporations serve as the primary source of capital for high potential growth firms. I want to quickly, and I see Emanuele's giving me the look. I got to be quick. I'm really going to try to be quick, but want to sort of highlight 4 really important elements that I think are critical to the sustainability of these ecosystems. So the last decade, we saw the emergence of just really sort of vibrant startup ecosystems, a lot of capital flowing. But the question is, are these going to be sustainable, or are we going to see the disappearance of them? So the first is programs which provide an incentive for private capital to come in. I don't actually believe, and again, I'm back at the University of Chicago, so I feel I can say it here. But I believe that unless you generate attractive rates of return on these investments and bring in private capital, these ecosystems will not be sustainable. And I'll talk about some of those sort of the first two types of promotion, government and DFIs, in a second. The second is skilled investors. One of the areas that I've done a lot of research on is this area of what builds success in venture capital. The GPs, the managers of those funds, matter a lot. And in many of these markets, we see things like government programs as full employment for anybody who wants to be a VC. That doesn't lead to the best people managing the capital. The third is something like the prior slide that Chris put up there in terms of Emanuele. You need a supply of talented founders. I won't have enough time to sort of dive into this, but there are national strategies you can have about how do you build a talent base for high potential entrepreneurship. What Emanuele's slide earlier showed is that you need people with a high degree of education and experience. Emanuele and Shai Bernstein and I have done a very large global survey in more than 50 countries, and you sort of see the education level of the people who are either current founders or want to be founders matches what that slide said. So there is that role. The fourth, and I'll probably touch a little bit on this, but it was alluded to over lunch a little bit, was the role of exit markets. So private capital comes in. Private capital, even if it has a long horizon, doesn't have an infinite horizon. And one of the things which is problematic in most of the ecosystems is they have not solved that problem. And thinking about the typical exits, IPOs, acquisitions, strategic acquisitions, the question is, how do you have both favorable government policy, financial market policy that makes that attractive? And again, that's probably beyond the scope. For those of you who, I am working on a book, so all of you should pre-order the book. It's, I'm happy to come back and sign the book sort of later. But one of the interesting things is if we look to the Yozma program, so again, back in the early 90s, I wrote a case on Yozma. It was a one-time fund. It was a government fund that financed 10 venture capital firms, and it had a number of requirements. The first of which is that it should be matched by at least 3 times the amount of private capital. So if you wanted the money, you had to convince investors to take the capital. The government actually provided part of that incentive by capping their rate of return at 6% per annum. So a higher rate of return meant that there was leveraged returns. And then the other requirement was that they had to partner with a non-Israeli venture firm. They were all US venture capital firms, experienced. And so you had this sort of mentorship role there. It was wildly successful. If you actually do the family tree of today's venture capital industry in Israel, they all sort of trace themselves back to those 10 initial funds. But literally, it was a one-time thing. If I go to some of these markets where governments are the primary backer of venture capital, I won't name the country, but there's one country in which 2/3 of the capital over the last 20 years have come from the government. And when I asked that minister what the rate of return over 20 years has been, he said, that's not the metric we follow. And again, the question, again, I have a strong view that unless you can provide attractive rates of return, risk capital aren't actually going to sort of come in. Okay, can I go to the next page? Okay. Again, we can go, there's a program, the European Development Bank, their Jeremy program, that we can go across a lot of the markets. And they all say they're doing Yozma, but none of them are thinking about how to do that. The second one is the selection of venture capital managers. Who do you want to put the money with? Again, it's not just my work, but a lot of other work has gone in that the value that the VCs add are critical. That they need to understand startups, they need to sort of be able to help and mentor. But in most of these markets, there's little role for value add. When I was in the MENA region, again, most of the, especially Saudi, UAE, and like, they have these sovereign funds that are investing in venture capitalists. Commercial bankers are the most common background to become a venture capitalist in the MENA region. I won't comment. And so the real question is how do you find those kind of people in a market that's just emerging? Do you import that talent? Again, one of the interesting things is providing the right incentives for global firms to potentially come in, mentor. mentor local firms, sort of, and the like. Again, if we had another session, Emanuele, maybe after drinks tonight, we'll do another session. I do think there's a big role to think about government policy on talent. There's one of the things that we've sort of seen in terms of certain countries have done a really good job of attracting expat talent. The education data that you saw on what Emanuele mass sort of where these folks come from, and you want to sort of do sort of a little bit. Maybe the last thing, and I've been going on way too long, and my just tell me to shut up, old man. But is this real issue of exit markets? And hopefully we can have a discussion here about how we sort of make that sort of attractive. Again, if I go back to the Yozma case, the one advantage that the Israeli ecosystem has is that they don't build for Israel. They build for a global market, and they all go public in the US or acquired in the US. The other market, which really, again, for those of you who are interested, that has just been transformed by startups, is Estonia. When I went to Estonia, if you look on a per capita basis, it's got the most startups and venture capital per dollar. The interesting thing is when I talked to folks in Estonia, the one thing they sort of said, which is really important, and this will sort of come back, was the ability to exit and the ability to sort of have those success stories. So it comes back to this issue of that in order to be sustainable, you need to create those success stories of those exits that generate return and then drive the private capital back. I'm actually going to stop there because I've spoken to my Chris, so you should have pulled the hook before. But anyway, yeah, happy to take this in any direction you want.
All very good. Thank you. Okay, so let me turn to you, and maybe you could start by telling us a little bit about EchoVC and what you're doing. Thanks.
So yeah, so it is EchoVC.
I got my slide.
Right. So, and what's actually funny is that when I named the firm, it was really about echolocation, and so navigating in the dark, sort of below sea level. And so everything around sort of below sea level is something that sort of works for us. I was at Intel for 10 years, and I led semantic technology investing for Intel. So then I now decided to start a firm that was focused on the missing markets in venture, and the two markets that were most correlated were Sub-Saharan Africa and Southeast Asia. And I went out to the market thinking people would sort of see the same thing I saw, and they were laughing at me. They were like, these markets are never going to matter. And so go focus on Africa, and rub my head and say, go do something small and you'll be fine. And so I decided to start Africa. And we were the first firm to be chosen to manage a government-sponsored fund in Nigeria, an ICT fund with $10 million. Key takeaway, don't do anything with government when it comes to funds. And and they defaulted, and they took the money and wanted me to share it, and I was not going to do that. So that was that. But what was also interesting, I think, was that we celebrated our 10th year last year, and one of the things we did in coming to that 10th year anniversary was to pause and sort of rethink what we're going to do in the next 10 years. And so a lot of and I think this is the reason why, Emmanuel and I sort of like, as we say in Nigeria, we're like 5 and 6, we're like close like that, is because we tend to spend a lot more time practicing what we call an observational VC. And so we challenge a lot of the theories because they don't work with what we see in practice. And so, one of the things we sort of paused and sort of taken a look at was, what types of founders should you be backing if you're going to do venture, right? And we spent a lot of time coming up with what we call a founder archetype. And we just published it as part of a report out we did on the deployment of a pilot fund we raised focused on climate. So what are the founder archetypes that we want in these markets? And they end up being, it's a very specific signals that you see repeated. One of them certainly is that, they're very mission driven. And I think a lot of people tend to conflate social impact and say, oh, social impact must mean you must be unprofitable. Or social impact must mean that you cannot sort of build a commercial success. And that's not actually true, right? And so these founders are very mission driven. And that was sort of one checkpoint we always wanted to make sure, because we like founders that are what I call the with or without construct. With or without you as a VC, I'm going to do this business, right? And so we saw those ones. And then the other thing that was kind of important when you're operating in these emerging markets was integrity. And that is one thing I certainly struggled with over the first 10 years. And I've kind of just accepted. And the way I describe it now is, you know what, I'm comfortable with ambiguity. You know, I just don't look, you know, I'm just gonna be like, nope, it's not happening. Nope, not looking at it. And then, you know, the third thing was how these founders, you know, they ended up having what I would call pastor-like magnetism, right? They could attract customers and could attract teams, right? And they'll be broke. I mean, absolutely just broke, but the followers will show up, right? And so that was another sort of element of the archetype. But the most interesting thing was this high resolution understanding of the customer they wanted to serve. And many founders that sort of tried to take the American style of venture and execution got lost because many of them didn't understand that if you raise 20 million, you're going to have to spend 20 million. And these are markets that will take your 20 million, all of it. And the next morning, never remember you, right? So you had to sort of go win on sort of, it was house to house fighting. You were always very sensitive to how you were spending money, but you also had empathy for the end consumer. And I'll give you sort of a bunch of different examples. So we have a company that's probably the largest edutech animation platform called Kukua. They're based out of Nairobi. And so they built this animation based out of, very similar to Dora the Explorer for those of you who have kids, for those of you who act like kids. But it's you know, and so what they do is they've created these animation episodes, 5 minutes, 11 minutes, and the like. And so we're doing this very large distribution deal now. And, you know, and people are like, oh, this is going to be expensive. And I pointed out to them that this team designed each episode to be less than 30 megs. So you could literally pay 3 seconds of data to consume the episode. It is designed for the mass market. So it's not the, oh, let me go find the top 1%. Nope. So you could essentially, you know, we've always sort of been big believers of the fact that when you're serving these markets, you have to have mental constructs about how they spend and how they think about it. So we have this thing called the spontaneous spend threshold. It's an internal thing we do, which is that certainly in Nigeria, the metaphor is how much does a bottle of Coke cost? And whatever you're pricing your digital service, it should not be more than that. Because when they're in traffic and it's hot, it's a spontaneous spend. Anything more than that and it becomes a trade. Then they start thinking. And once they start thinking, you've lost them as a customer, right? So everything's sort of designed. So Kukua is like, you know, we roll out this thing where it's $200 for the subscription per month. You know, the DSTV, which is sort of like the cable thing, I think they went down from 1.4 million subs or 2 million subs to 140,000 year over year. Right? You can sort of see how the edge consumer is getting squeezed. So how you're designing these products and services will be very important. And so that's the other thing we kind of look at for these founders. And I think because of the traditional strictures of venture, which, you know, when you think about it as a portfolio, right, you're thinking, okay, I'm going to get 2x or 3x, but you're saying, you know what, I'm going to write off 80 or 90% of the portfolio, and then one of them is going to drive return. That tends to be true if you stick to pure VC. But our sort of thesis has been, it has to be different. It has to be more of a hybrid. You're going to invest in high growth startups, but there's also this sort of weird group or cohort called high growth SMEs, right? And they tend to be much better performing. We have some of them in the climate portfolio that are 50% gross margin businesses. Right? I've never seen a 50% gross margin business in fintech. It literally doesn't exist, right? And some of them, you can sort of see how they can get to 70%. Those are software margins for analog businesses. And so when you're trying to explain to people, they're like, no, it's not true because they've never seen this, right? And that's always another interesting thing. And then when you're coming to these markets as an investor or the like, you really should pay attention to the signals. and understand sort of what you're trying to solve for. And, you know, and I know people, we've never had DFI money, for instance, right? And so one of the things I always ask myself is, what is it about Eghosa that DFIs don't like? And I think a lot of it is because we don't kind of believe what they're doing. That could be it, right? You tell me you're going to come and do SMEs and you invest in 2 funds. What's that supposed to do? I don't know. What are they supposed to be doing with your whatever it is? You know, we went with fundraising for a seed fund. We said we're capping it at 30 million. They were like, "Oh, could you do it at 50 to 100?" No, no, because I'm optimizing for product market fit. But many of the funds you're doing are optimizing for DFI fit. And so the market is struggling. There's nothing happening. The money's not getting to the entrepreneurs. And everybody's like, "Oh, we're just going to pretend that things are great." And the truth is, things are not great, right? And there's a ton of money that's sort of trying to figure out how to get into the market. And you've got these intermediaries that are just not doing the work. And no one is challenging them. No one is, you know, is questioning what they're doing. And so a lot of it is just, can we do this better? And our sense is, yes, you can. But much of the stuff has been, I mean, like I said, when we did this 10-year look back, there's just a lot of stuff where I was just like, oh man, we made a mistake here, we made a mistake here. Okay, great. How do I fix this? And my final points have been, you know, I wrote this post a few months ago, and it was sort of one of those things that just woke me up one night. And I was like, oh, that's it. Smallholder farmers and ag and food systems, big thing, right? So you go into these large conferences, people are dressed nicely, you know, and they come and talk about how they're going to solve the problem of smallholder farmers. Meanwhile, I don't see any smallholder farmers in this conferences. You know, there's a whole bunch of people saying we're going to solve their problem. And so I went into one of those conferences and I just came out, I was angry. I was just like, this is rubbish. Rubbish. And so I now wrote this paper and I said, look, I think I finally figured out why there's no progress. And I think the problem has been a labeling problem. And the problem was, you look at smallholder farmers and you think, some guy has 4 wives, 17 children, trying to sort of get some yield. No one really understands the supply chains, whatever it is. And I'm like, no, you keep calling them that, so you are almost sort of derisory the way you treat them. I was like, we're going to propose a new term for them, risk managers. And once you think of them as risk managers, you start to think differently. Because you realize today is climate risk, tomorrow is input risk, third day is yield risk, then supply chain risk. And then once you now sit down and figure out that they just deal with sort of this assortment of risks, then you can now start targeting the interventions. You know, and I hear now that that post has gone places, and I'm like, look, you know, the proof is in the pudding. We need to sort of see how things change. But a lot of what we're trying to do as investors, right, in these markets is to find what we call these elite founders and then back them. My final point is the elite founders in these markets that can drive change have optionality. And when we spend a lot of time trying to do diligence on people for 1 year, and then the fund managers, it takes 42 months for a fund to get raised in Africa. 42 months. These folks eventually just sit down and say, you know what, I could be doing so much better in the UK or the US or Canada, I'm out. I'm gone. Right? And so our thing is, look, once you find these elite founders, and yes, in some ways based on these charts, they're kind of elite, right? But at the end of the day, there's a matching function there. And if you're able to find them, you back them. And that's more important than anything else.
Great. Thank you. With you on that point, but let me, Dennis, you can bail out the DFIs here.
Yeah, well, we'll leave that for Q&A. No. I'll get started a little bit, but yeah, but I think that's more of a conversation than sort of long-winded interventions. So, Chris, maybe I'll cover a few things to start with. So, you know, you talked in the beginning about kind of equity versus debt in terms of portfolio. So I'll talk a little bit about why equity matters for IFC, how we think about that, and say a few things about some of the challenges that we face, and then try to end with actually a few thoughts about where some of the interesting research is happening and where perhaps we might need a little bit more research. Hopefully that will resonate with the audience here. So to start with, so today equity for us at IFC is about 10% of our annual commitments, and Alfonso was mentioning during his interventions during lunch, our ambition is to increase that quite a bit. Now, again, I think there's a question there of how far to increase it and what is the optimal portfolio composition. Maybe that's one of the interesting questions to think about. I'll leave that aside, but certainly our ambition is to do much more on equity. And why is equity particularly important? First of all, we think of it as a class of assets that's particularly scarce in developing countries and countries where we operate. I think, again, that's not a surprise to anyone here. It's also obviously less sophisticated tends to be generally less sophisticated in terms of the instruments, et cetera. So this is an area where perhaps the needs in relative terms are greater. The kind, why is that? Of course, a number of challenges. Paul sort of just flip around what Paul was saying are the success factors. These are the challenges you kind of face in terms of equity markets in developing countries. So markets are shallow, there's few investors, there's limited exit opportunities, there's all kinds of regulatory and corporate governance issues. So, it's a difficult area to be in. On the other hand, we know that, again, equity as a class has played a disproportionate role in terms of financing innovation, in terms of helping companies get access to long-term risk capital. This particularly matters for small, young, high R&D firms, which are also, of course, we know from the literature, are firms that tend to create the most jobs. There's sort of macro level effects in terms of having more developed equity markets, having a number of positive associations at the macroeconomic level. So again, we can go on and on, but we see that as an area, again, of the both scarce and high development impact. And then specifically more as an investor, as a DFI, we also see equity as a way of developing relationship with clients, of being able to have some voice, being able to support some of the development outcome like ESG and other sorts of things when we start building relationships with the companies where we invest. And some of the work that has looked at the performance of the IFC equity portfolio has found that in general, we do tend to have a longer horizon than sort of purely commercial investors, and tend to be a little bit less cyclical than some of those investors. So perhaps there is some truth to our ambition on that. Kind of going more into the challenges, of course, beyond sort of all of the standard issues that we mentioned before. Local currency becomes a very big deal, and we've heard that several times in all the different panels. Of course, as an international investor, we raise our capital in dollars. Investing in local currency can become a challenge on both ends, both for us to sort of raise that currency in a way that we can then invest in these companies, but then also to bring other investors along. So again, at lunch, Alfonso was talking a lot about mobilization and the fact that at IFC we bring more kind of co-investor money to our transactions than we actually put in our own account. And I think and that has changed dramatically over time. So we several years ago, the ratio was less than 1 in terms of mobilized. Today we're getting, we're surpassing 2 to 1 and moving further in that direction. So but these investors are looking for returns, and those returns can be challenging in local currency terms. We can go through a whole bunch of successful investments that we ourselves have done in markets like Turkey, South Africa, et cetera, that converted into dollar terms start looking not particularly attractive. And then again, I think, once you sort of think about how you crowd in this international investor money, that becomes a real issue. How do you balance these sorts of things, and how do you exit is also, of course, another challenge there in terms of, on the one hand, again, being, wanting to stay longer, wanting to be less cyclical, but at the same time having other investors that are looking at their performance and are wondering about when they're going to get their money out. So I think, this is something that we continue to face is when it comes to PE and VC end of the market, also smaller ticket sizes. We can talk more about that, but they do become an issue for us in terms of, how do you how do you finance these transactions in the sense of, the cost of preparing them, managing this? How do we allocate internally portfolio between larger tickets and smaller tickets and still are able to achieve the volumes that we need? And then again, sort of coming back to the point on returns, when some of the work that has looked at our performance has found that in general we have been able to outpace the public sector emerging market returns, but have lagged a little bit behind some of the PE benchmarks like Cambridge, right? And then, and again, the story there is much more nuanced than averages, because if you look at Cambridge, for example, they're very heavily weighted towards China. They're very heavily weighted towards sectors like tech. You might say, does that kind of a portfolio composition make sense for a DFI? Perhaps not. Perhaps you want to be more diversified, both in terms of sectors and in terms of countries. But if I'm going out there and trying to raise money and say, hey, this is a benchmark from Cambridge, and I'm not able to meet that, obviously that's not the best selling point to start with. So I think all these come together. They do create a number of challenges in us to be in these markets and to increase our participation. So let me just say a couple of things on general success metrics, and then end with the research angle. So I think when generally countries think about successful VC ecosystems, right, a number of things come, like how many unicorns did you have, and people start looking at Israel, and people start looking at Estonia, and these are the same conversations that we have when we talk to both private and public sector clients. And I think those are useful examples. At the same time, I think they can kind of lead you perhaps in not the most useful direction in terms of just chasing a particular number. I think Japan was well known until very recently, having sort of number of unicorns that was in single digits. So, and not everybody is gonna be Finland or Estonia, and you're always gonna have the most successful startups that are gonna move from your local market, eventually to New York. That doesn't mean that you were not successful. In some ways, you may actually think that is the definition of success. What you do want to do is you want to develop a local pipeline of talent. You want to have local sort of solutions. So going back to the paper by Marcio, Mariana, Emanuele, Tommaso, you probably want an ecosystem that's not entirely driven by both the capital as well as the talent that's coming from abroad. So lastly, what are some of the big questions that we're puzzling around? So one is kind of how to balance between direct investments and funds, right? So when we get the smaller ticket sizes, the better way for us to manage this has been to go through funds rather than direct investments. But that sort of perhaps diminishes a bit of the narrative in terms of the additionality that we bring and the control that we have. So that's a tension we're trying to resolve. We're thinking about how to kind of tailor financing to different stages of the firm life cycle. So again, the work that we're doing in terms of startups, on accelerators, on venture capital, how to think about some of the determinants of decision making by investors, the risk return, some of the stuff you still have here on the slide, Chris. Thinking about how to reduce the cost of capital in general for firms in developing countries, as well as sort of how do we link some of the real and financial sector things in a way, how can we reach smaller firms through large firms, which in some ways may be easier to finance. So perhaps, sorry, one last thing is, one of the things I've been wondering a lot, and we haven't talked much in this forum, is about exit, and not exit in the sense of selling, the company, but exit as in, entrepreneurs exiting the market or firms closing, right? Like we want to think about how to channel funds to the companies that grow, but obviously, when the companies grow, those resources have to come from somewhere. And there's a nice stream of literature on entrepreneurship about kind of scientific reasoning and kind of helping people realize that maybe what they're doing is not the best idea and exiting more quickly. There is sort of some nice literature on investment readiness, again, about how you actually help investors differentiate between signal and noise and invest in better companies versus worse companies. And then I think there's a question around sort of the social return. So now we're coming to the theory. So it is socially optimal for people to realize they're making an error more quickly and get out of business. Scientific training works, but obviously we can't train all entrepreneurs. So to what extent maybe some of the solutions on the finance or financial sector side can make this process a bit more efficient? Thanks.
Thanks. Yeah, I've done an imperfect job of managing time, but I'm going to make one short comment and ask a question, and then I'll open to some questions. We'll have some minutes left for some questions. So the comment is really Eghosa, in to you in a sense that when one of the most common comment that BI gets is we're slow, and the process seems bureaucratic. Partly that's the nature of who we are. We're a publicly owned company. We live in a political world. Financial risk scales linearly. ESG risk is 0, 1. We can invest $1 in a company, and if there's a serious incident, it's so the due diligence and things that we have to do is part of the nature of who we are and the glass house that we live in a sense. And so I think that's a challenging one to get around. I mean, we talk about it all the time, and we're trying to speed up processes and things like that. But I was struck by, so that's sort of the comment, and it leads into the question, which I was struck by your comment that it takes 42 months to raise a fund. And I guess my question for particularly for you and Paul is, what does it take to fix that? What is it in these because this is not just the DFI's problem, right? That in a sense, I think especially as we think about local currency and things like that, we have to think about how we get more local investors. I look at what's happening in India now. We are beginning to see the domestic ecosystem come up, and so the question is, if we look longer term, what's it going to take to get to deal with 42 months, but to move to a place that's where there's more local participation, and there's more, and whether it's pension funds or whether it's high worth individuals and so forth.
So, I mean, I think it may be trite, but success breeds success. You need those sort of success stories. So having those returns, I mean.
Sorry, and success at what level? Success at a country level, or success at a fund level, or success at a
fund, and even an individual company level.
Right.
So these narratives around success stories are really, really important. The Estonia example is Skype. So Skype had, I think, 6 of the 7 co-founders of Skype were Estonian. When it went public, it was bought by eBay in 2005 for like $3.5 billion. Everybody in Estonia, knew somebody at Skype, and sort of really motivates, and then money comes in. I don't think you need to have like a fund return, 30% IRR and have the fund close, but I think you need that sort of story to tell about we've had these huge exits. This is an attractive area, and that brings the private capital in. The other thing,
but can I say, so Nigeria's had several successes in that sense. Flutterwave. I mean, some of the fintechs. What? So apparently, yeah. Okay. But there have been some fintechs in Africa that have
and I mean, if we look at Brazil, for example, Brazil's had a bunch of successes, and Brazil is very, very vibrant. If we look at Singapore, so again, Singapore is sort of the same sort of way. They're different markets, and those individual stories can actually travel a lot. The other place, which I think is really important as well, is back to talented founders have options.
Yeah.
And having that narrative around this is possible will lead them to be more likely to want to passionately do their startup, as opposed to, I'm going to go to Meta, I'm going to go to Alpha, I'm going to do whatever because they're going to pay me a lot of money. And so I think having a narrative is really, really important.
Yeah, and I think the challenge I think we face is that sometimes these successes are so vertically focused that all the founders just want to go start a fintech company. Because when you look at a bunch of the unicorns and whatever it is, they just tend to be disproportionately fintech, right? So then you're now attracting all the founders into one space. Meanwhile, if you sort of think about it from an impact perspective, there's a lot of other stuff that needs to sort of get built. And so, I like the success stories, but at the same time, I think the focus really should be on really taking out a lot of the friction in the processes, right? How do you raise money? As a fund manager, how do you raise money? How quickly can you raise money? As an elite founder, how quickly can you raise money? Go test your experiment. There's sort of steps along the way. And I think there's also an interesting sort of dynamic. And, like I said, I'm really grateful to our backers for allowing us to run this hypothesis pilot fund. And that is that there's a new cohort of companies when we're talking about equity and debt.
Yeah.
Very interesting insight. They will raise some amount of equity, and then they will never want to raise equity again.
Right.
Because they have built a model that they can scale on debt, working capital, whatever it is. And there's a whole bunch of them in that portfolio now. They're not interested in raising any equity. And so, and here was interesting. We're out raising an equity fund. We go out to raise a sort of debt sleeve, go out to raise 10, I get offered 20, right? And I'm like, oh, that's interesting. But I've got the equity part of the house. So I'm out there still raising the meanwhile, that guys are twiddling their thumbs saying, when are you going to get started? Right? But I keep telling them, I was like, look, once you have nimble debt facilities, right, you're going to see a very different set of companies. And we talk about success, and everybody says, oh, unicorn, unicorn, unicorn. The truth of the matter is this. You're going to raise these companies, they might raise a total of 2 million in equity. They start generating 20, 30, $40 million in revenue, gross margin is 50%. They're spitting off free cash flow. You as the investor is getting paid in dividends every quarter. And someone is saying, oh, you're not a unicorn. And I'm thinking, sure, you go do what you want with your unicorns. I'm happy with my free cash flow dividends. Right? And so I think even just changing that narrative about what does an exit look like? What does liquidity look like with these new types of companies is going to be very important.
But then what's your fund like? 10 years, 15 years?
So this is interesting. For planning, we keep telling people you need to go longer.
Yeah.
Right? 15 years, maybe even 20. Right? But because we get foundation money, you have to keep recycling the money and a whole bunch of things and like. But yes, you're absolutely right.
Right.
And we've seen this in Africa where a bunch of fund managers have been pushed. You're like, you know what? Look, you can't raise your next fund until you get liquidity. But what you then find is that they now do this, what we call, premature evacuation, right? Where they just sell the best assets too early, right? And then they're like, oh, we got liquidity, and then those fund managers never amount to much of anything after that.
Let me open up the questions. Let's take before we answer them, let's take 3 questions and then answer 3 questions that we have. Yeah.
Okay. I want to push back a little bit on this whole, jumping from
That was a quick question.
quick. Okay, but I have to give some comments. Okay. I'm a full fan of, we have to do it with the private sector, private capital, VC funding, all that is great. Okay. You start up, that's great. But from there, jumping to development and GDP growth, that is a long run. And in that way, I fully agree with Omoigui. I mean, like, how do you get rid of the government? How do you get rid of the macro policy? How do you get rid of all those things? I mean, the risk of the currency, the risk, all those
That was
things.
a good question.
Let me finish. All those things come back to macro, and then just in terms of the question, how do you then convince both your local investor and then the foreign investor you can be the most successful venture capital? And I'll give an example from Turkey. Take the company to the New York, right? I mean, but then you escape the country because you're afraid, Erdogan can put you in prison. How is it going to work out?
We got it. Okay.
So Israel is not a good example. That's what I mean.
Other questions? We're gonna take a couple more. Yeah.
Yeah, this is mainly for Eghosa. You talked a lot about product market fit.
Yeah.
Curious to know your thought on product non-market, meaning how you think about non-market risk and criteria for that.
Okay.
And one more here, and then we'll go. Yeah.
I guess what you're advocating from what I hear is this typical Silicon Valley VC model in the way that, return drives everything, and also that fail fast and just keep on doing. I wonder if you have real evidence that that is the way that it works best for these developing country. I work mostly in Africa. I would say my experience is that the big difference between founders in Africa and here is commitment to their business and the resilience and refusing to fail. But everybody's looking at VCs as a model. Have you thought through whether or not that's actually the right model for developing countries?
So, I wholly admit that there are a lot of other things, and Emanuele knows that. He's read all the module notes for my class. So the legal and regulatory environment, absolutely. The level of corruption, how they deal with defaulting on liabilities, restructuring, all those kind of things. And so there are a lot of countries where this isn't going to work because the legal and regulatory environment doesn't work. The macroeconomy. I can tell you the story. I went to, when I was in Egypt, I was stupid because I changed my dollars into Egyptian pounds before I left. And in between, there was a 30% devaluation. So I should have waited. But that is sort of really, really important. The other piece of this that I talk a lot about in terms of what I'm teaching in the book and hopefully get into in other research as well is sort of the role of culture. There's a lot of social psychology research on things like uncertainty avoidance and like, and this gets back to, how do we think about the stigma of failure? And that if you start a business and fail, it could change your family, all those sort of kind of things. And so I believe that in the long run, that one way we increase economic well-being is to have high productivity jobs. One of the ways we do that is have these types of firms who can build. It's not the only solution. I think we need lots of sort of things, but I do think, and we can look to a lot of countries that have utilized the tool of high potential entrepreneurship to improve economic well-being. And so again, lots of other factors. I think it's one tool in sort of the quiver to have sort of at your disposal. It's not the sole solution.
Yeah, so I'll take that point and then go to the thing about the non sort of product market fit or not market fit. So one of the things we spend a lot of time and have done has been trying to figure out what should market fit and what should the product look like. And so the market is, can be somewhat dynamic, but the one sort of construct we've built is what we call zero cognitive load product. And that is essentially, have you built a product or solution that adds no additional cognitive load to the consumer? Right? Because in these markets, their daily cognitive load requirements are so high, right? It's power, it's fuel, it's traffic, it's, not getting paid your salary, it's school fees, it's, all kinds of things, right? And so once we think about that, it's through sort of those lenses that we now say, does this product actually meet that standard? And then you can now start to think about whether or not the product has a multiplier effect on the people that it's going to touch. So that's sort of how we think about that. And then I think to this point about sort of risk of failure and the like, it's so important. And, because I was in Silicon Valley for a long time and, I still have investments there. I want to share a very quick story about something that occurred a couple of weeks ago. So there's a founder who I've been helping for years, love him to death and whatever it is. And he's doing some very interesting stuff in fintech. And I was talking about another founder that had failed, who had been in Africa, and how, she has PTSD, and I've sort of been working her off of the PTSD cliff for the last year and a half. So 8, 10, 12 calls a day. We talk about everything and the like. And he said, this is crazy. And I said, what? He said, do you know that I've not had time to mourn my last company? And I said, what do you mean? He said, the Valley is so good with failure that he shut it down. They were like, yep, all right, how much do you need? What are you starting? Okay, we'll fund it. And he realized 2 weeks ago, in the middle of the Series A raise, that he has never actually mourned his last company. And so he disappeared for a week to go mourn it in the hills of, Palo Alto and Los Altos Hill.
So that's interesting. So you're just saying it's not the psychology. It's that's a story that it's not the psychology. It's the ecosystem in a sense that you're in that allows you, that doesn't allow you the luxury in a sense.
Having this emotional burden that you're not even paying attention to. Yeah. And I was like, look, this is the thing, because in Africa, your whole family will remind you that you failed. All the time. Okay, so you will not ever run away from it because it faces you everywhere, right? And that also has its own deleterious effects, right? And so how you balance that is sort of interesting. And yeah, it's so random because I sit in these two markets and I get very fascinating counterpoints about.
Can I just add, my issue, in fact, wasn't the fear of failure. I mean, yes, cultural issues are there. But what I've seen is that, you know, there's so much commitment, especially for some of them that's African founders, to the service that they're providing or the product they're providing, and they are very much interested in improving the lives of people in the community they are at. Therefore, they don't want to give up because the influence is not them. Oh, they can just jump ship and, you know, enough to go build something else, but what about the rest of the people? So I just think that a lot of times we don't take into account of what drives people in different countries that
I-
much less
yeah.
wealthy than we are.
Yeah, it's not just Africa though. Like when I was in Pakistan, I met with the founders there, two who were educated outside of Pakistan. One had extensive startup experience in the US, the other was McKinsey, and they went back to Pakistan to improve the lives in the country. So I think that's in general in emerging markets that many, if not in most of the founders in those markets do it partially for the financial reward, but equally for most of them is the fact that they're giving back to their country, their society, and their communities.
I was told that going back to Africa was the singularly worst exercise of judgment that people had ever seen. Like they were like, you're sitting in Palo Alto, you could be a billionaire. You know everybody, this is your world. Why are you doing this Africa thing? Right. And so I think there's a lot of us like that. And so, but I do think the point that you're making that is quite nuanced is the burden of the belief, right? When you go into some of these markets that, you know, we talk a lot about the edge consumer, right? And we say this all the time that if you give these consumers optionality and they learn to trust you, right? It is something that is very hard to earn. So even when the business is not going well, right, you don't quit because you look at all the people, both direct and indirect, that are relying on you, on your products and your service, and you're just trying to figure out how am I going to explain to you that this business is no longer sustainable because they love the product that you've given them. And that's very hard, right? And I think that's why as investors, you're both a finance guy and a therapy guy and a lot of other things guy, right? And that's how it sort of works in real life.
So this panel's going really well, but we have to quit as well. So thank you very much for this. Upstairs to the 6th floor, and there are drinks. So we can continue the conversation.
And this time we should take a. Thank you.